regardless what your ultimate gifting strategy is, whether you're gifting assets outright to individuals or you're gifting assets into irrevocable trust for purposes of protecting it and further estate tax planning, how you do the gifting is so important. You're hearing a lot of conversations about estate tax right now because in 18 months, estate tax laws are subject to change. Right now, 2024, you can pass up to $13.61 million in assets free of any estate tax. That's a lifetime transfer tax. So it's not just upon your death, but the IRS actually looks at gifts you made throughout your lifetime as well as a transfer upon when you pass. So you hear a lot of conversation around gifting strategies, and this is probably the easiest way to get assets out of your individual name to others. And so that's what it really comes down to, is getting assets out of your individual name, putting them in trust, giving them to other individuals. So when you hear people talk about it, practitioners, attorneys, other planners, you'll just hear them talk about this idea of giving assets to other people. That's a great strategy, the gifting aspect of that. But there's a piece that's missing from this gifting conversation that is not maximizing your ability to reduce your estate tax. And that is discounted valuations. So this is still related to gifting, but what we want to focus on is this next level of advanced estate tax planning. And it really is discounted valuations. So there's this whole world out there of professionals, CPAs and others who do valuations of business entities, and they look at an entire spectrum of things as far as, what industry you're in, how you've done the last few years. They look at your books, your financial statements. They look at your key employees. They look at your succession plan. They look at, how old is the owner and the ability to sell the business and all these different things. So one of the other things that comes into play there is how the entity itself is legally structured. And so one of the ways that we reduce or maximize your ability to get more assets is take assets, put them into a holding company, whether it's a family limited partnership, an FLP, or a family limited liability company, an FLLC. And we structure that in a way on paper that allows a valuation expert to come in and do a valuation and give you significant discounts. And the easiest way to do that is to structure this business entity, the LLC or FLP, in a way where it is mostly non-voting units. So maybe you have one voting unit and you have 99 non-voting units. That alone, because of the significance of those non-voting units, allows a valuation analyst to come in and provide a significant discount for lack of marketability and lack of control. I won't go into that, what that means. Maybe I should have a video with a valuation analyst about what that actually means. That's actually a great idea. We're probably going to do that. But point is, you get significant discounts. And you look at discounts from high 20% to maybe even up to 40%. So what does that mean when I'm talking about high 20% to 40%? Here's an example. Let's say you have an LLC and you take a brokerage account and you move that brokerage account worth $10 million into that LLC. Now you take, let's say, that 99 voting units interest and you gift it to one of your children. Okay. We have to value that 99% interest. We're not looking at specifically at the securities, we're looking at the interest that you gifted. And because it's a non-voting interest, that valuation expert is able to give a 20 to 40% discount. So you move $10 million into that entity. After the discount, let's just say you get a 30% discount. Securities worth fair market value of 10 million now are an entity that's worth 7 million because of a 30% discount. Rather than giving 10 million in securities to one of your children for purposes of reducing your estate tax, you're giving them a $7 million interest in an entity that you can continue to control. Instead of having used up 10 million of your $13.61 million exemption, you've only used 7 million of your $13.61 million exemption. So now you have an additional 3 million. You still have 6 million in exemption left over. And so this is the way to really maximize your ability to gift. Regardless what your ultimate gifting strategy is, whether you're gifting assets outright to individuals or you're gifting assets into irrevocable trust for purposes of protecting it and further estate tax planning, how you do the gifting is so important. So remember that discounted valuations are a person's best friend. So don't make any gifts without having a conversation around how to get these discounted valuations on your assets. It's so important and should be a part of anyone's gift and estate tax strategy over the next 18 months.